In order to have a complete picture, we can't just look at what the Federal Reserve is doing. While the US central bank does have an incredible amount of influence over the business cycle, ultimately people and businesses borrow from domestic banks, not the central bank. The central bank loans money to domestic banks that in turn loan out money to people and businesses. Just because the Federal Reserve has been loosening up its policies over the last year and a half doesn't mean that domestic banks are necessarily giving out easy loans to people and businesses. If that's the case, this can still lead to an economic downturn even though the Federal Reserve has stopped raising interest rates. And we can see what domestic banks are doing by looking at this chart right here. It shows us the number of domestic banks that are tightening their lending standards to businesses. In other words, when this line is rising, it means that domestic banks are lending out less money to people. When this line is very elevated, it suggests that credit is very tight, which is typically something that happens right at the start of a recession. The 2008 financial crisis is a great example of this. The Federal Reserve stopped raising interest rates in July of 2006, and over the course of the 17 months that followed, domestic banks continued to tighten their lending standards, eventually dragging the economy into a recession. Today, it does not look like domestic banks have been behaving in a similar way to pre-financial crisis. Since about the third quarter of 2023, domestic banks have begun to loosen their lending standards again. If we add the US unemployment rate on this chart as well, we see that tighter lending standards precede a rising unemployment rate. Again, if we shift forward these lending standards by a year and a half, it's a very close match. Yet again, that illustrates why we've been expecting the unemployment rate to rise throughout 2024. But here we are a year and a half after this peak, and it now seems more reasonable to expect a downwards trend in the unemployment rate again. So both the US central bank and US domestic banks over the last year and a half have been loosening up their lending standards. This is not something that precedes recession. So for the first time in over a year, we are changing our opinion on the likelihood of a recession. We do not expect a recession to occur in 2025, and this has absolutely massive implications. Throughout the entirety of 2024, we were calling for the stock market to move higher despite the risks of a recession. Now that the next recession is likely getting pushed out, that makes us even more confident in our call that this bull market in stocks can continue. After all, history shows us that the largest stock market drawdowns have been accompanied by economic recessions.